Good afternoon and welcome back to the show. We've got another takeover announcement today. We've got lots of trading updates to pour through. So thank you very much for joining me for today's roundup of London Stock Exchange announcements. I'm your host, Graham Neary, and please do subscribe to the channel if you're new. Feel free to share with your friends and hit the thumbs up as that also greatly helps the channel. Okay, hello to George in the live chat. You're very welcome, whether you're in the live chat, whether you're watching this on replay or in podcast format. This show is available in multiple formats. So George in the live chat notes that Volex, one of his favorite stocks, had decent results this morning. Any thoughts? And I did notice that Volex had been a requested share previously. So we are going to talk about Volex. And we're going to talk about a few other things as well. We've got AJ Bell, Deliveroo, LendInvest, Keystone Law. We've got Hipgnosis, Discovery, and more. So plenty to cover. Let's start with the announced takeover or recommended takeover. So I'll share my screen if you're on video. And here's the Vox Markets website. So we have a takeover of an interesting fund, an investment trust, Hipgnosis Songs Fund Limited. And this one always struck me as quite interesting because it's it was one of the few things which seemed to be truly uncorrelated with other things. So you would imagine that song royalties might be a little bit cyclical with the economy, but maybe not too much. Anyway, this one is going to leave us. It's had a few niggling issues and a few problems, and actually it lost a continuation vote last year. So its investors actually voted against it continuing to exist in its current form. And that was an overwhelming vote by Hipgnosis investors. 83% of shareholders voted against it continuing to run as an investment trust. And that was after the company had to cancel plans to pay a dividend, and it basically announced that the royalty payments it expected to receive weren't going to happen after some copyright changes in royalty payments. So basically, this story is coming to an end. The investors voted for it to finish up or to stop existing in its current form, and the board have duly come up with a takeover offer. So a 30% premium. It just goes to show that there's opportunities in lots of different places in the current market. You know, we've had I've only been doing this show for a couple of weeks. We've had plenty of takeovers already, and this is just the latest one. Okay, it's a special situation, but it is another company that will leave the market most likely. Seems like a very decent bid, $1.16 in cash. I think that's about 93p. Yep, 93p here. And a 32% premium to the closing price. So well done to anyone who was holding Hipgnosis recently, and especially if you managed to buy into it below the takeover price. I think the board here have done the right thing. They've done the best thing, I suppose. They've come up with a clean exit for everybody, and I think there can be few complaints now that this action has been recommended. So that's it. That's the end of Hipgnosis. It was nice knowing you, and I don't think we'll see its like again, because music royalty is not something that you see very often on the stock exchange. First time I ever saw something like this on the stock market in the UK anyway. So that's the end of Hipgnosis, and it's a happy ending. And it's not very often we get to say that with delistings in the stock market. We've got a few some less favorable stocks to talk about as well today. But let's move on to Volex, because it is a viewer suggested share. So there's a good bit of interest in this one. You know, Volex is not a stock that I think it's all that easy to get your head around, because they very proudly say how diverse they are, but then it becomes hard to pin down what exactly is the core product or the main division here. They say it's performance critical applications and it's power products. I think on the website they say they are global integrated manufacturing specialists. So what is at the heart of Volex? Well, I think the main point about Volex is that they are very good acquirers of businesses, and they've been acquiring other businesses for a long time. They have 12 acquisitions since 2018, so that is a considerable number. And during that time, they have been, I would say, quite impressively profitable. Maybe we can get some numbers here. So this on the Vox website, we've got revenues rising rapidly since 2019, and we've got pre-tax profits also growing very nicely hand in hand with the growth in revenues. So I think it's difficult to argue against the strategy based on the financials. But let's take a look at today's announcement. We've got a full year trading update from Volex, and they say further diversification and strong growth. And this full year performance is ahead of market expectations. So they very helpfully provide the consensus numbers in a footnote, which I think every company should do. And they've beaten these expectations. It looks like they've beaten them quite considerably. Revenues of over $900 million versus a consensus forecast of $850 to $873 million. So they've absolutely smashed the revenue forecast. And in terms of operating profit, there was a consensus forecast of $83.3 to $84.6 million, and they are beating that as well, slightly ahead of analyst expectations. So perhaps not beating it by very much, but beating it all the same. George in the live chat says that Nat, in reference to the executive chairman, seems to be doing a good job at the helm and has a good level of ownership, which is something I like. Yep, thank you for that, making that point, George. And I would point out, I mean, if I was to try and point out some quibbles, I was looking at the H1 results, and it seemed that constant currency organic growth in H1 was only 4%, 4.2% to be precise. So possibly the organic growth is fairly limited right now. But the the thing is, when you're dealing with a highly acquisitive company, maybe you can sort of turn a blind eye to that almost because the whole point of the company is to make acquisitions and to grow in that way. So maybe it doesn't matter if organic growth isn't huge. Um, Now let's see what are the other key points here. I think leverage is at a level that I personally would be comfortable with. Covenant leverage expected to be approximately 1.1 times at the end of the year. So as I've said several times, I think that's a reasonable level. And I was trying to I was looking at all these different parts: medical and complex industrial technology, electric vehicles, and consumer electricals, and I was trying to figure out how important each of these divisions was. And one difficulty I ran into was that the company uses geography as the basis of its segment reporting. So for big companies, you expect them to break out revenue, gross profit, and hopefully operating profit, and break out a few of these things into different segments. And personally, what I like to see is a breakdown by operating segment. But unfortunately, all I got in the interim results from Volex was a geographic breakdown, which doesn't really help me understand the importance of each of these divisions. Interesting that electric vehicles and consumer electricals have been the tricky ones, but that they have improved in the second half of the year. So maybe that's good news from an economic point of view if these two categories represent the health of the consumer. Maybe it's a very positive thing to see them improving. But revenues there do remain below FY 2023 levels. So I think that is a sign of consumer weakness in my experience, in my opinion. But maybe some signs of green shoots there when they say that there's a reduction of customer destocking in the second half. So overall, I do think that this is probably a very good quality business. Um, I'm not totally convinced that the organic growth is there, but the acquisition strategy seems to be working and seems to be successful. I would like more detail on the segments. And I think the quality metrics, when I checked them out earlier, seemed okay. Not spectacular, but okay. So yeah, overall, seems like a pretty decent business. Seems worth researching. And if you're a shareholder in it, best of luck. And this is certainly a fine update with the company completely smashing its revenue forecast and also slightly beating its profit forecast. So well done to Volex on that. And you're very welcome, George. And thank you for the suggestion. When you make suggestions to me, I may not get back to you on the same day, but I do take a note, and I will hopefully remember, because I've taken the note, to research the company the next time that they do report. So get your requests in, everybody, and we can have a bit of back and forth. And I enjoy reading out your own insights into your own shares as well. So we can have that back and forth and a bit of interaction. Okay, so let's move on to a share that I would say I have a pretty decent understanding of, but I suppose they could be my famous last words before I completely mess up this section of the show. But AJ Bell, I think I have a reasonable understanding of this business. I am a shareholder in Hargreaves Lansdown, which is a competitor of AJ Bell. I don't have a big shareholding in Hargreaves Lansdown, but I do need to declare it because it's the right thing to do. And Hargreaves Lansdown is the market leader. AJ Bell is sort of is probably we could interpret it or view it as the smaller, maybe younger upstart, but quite innovative. Probably from a customer perspective, I would argue it's probably offering slightly better value than Hargreaves Lansdown. Uh, so there's that. But anyway, you can see the shares are up by 4% today at AJ Bell. Quite a big company by UK small cap standards, 1.3 billion pound market cap almost. And there's a couple of different pieces to this. It's not purely the stockbroking element of it, which some of you may be familiar with as customers, but there's also the services provided to financial advisors, and there's also an asset management business managing third-party funds. So a couple of different pieces to this business, and I must say that this is an excellent update. Um, you can see the customer numbers are up 11% in the last year. So, given that, this is a very mature industry, 11% growth in customer numbers in a single year, I would say is very good. And that includes 12% growth in the direct to consumer business. So people like you and me, or people like you and I, sign up to trade shares or what funds or whatever on their platform. Now you can see that assets under administration have grown by a remarkable 17% over the past year and 5% in the last quarter. So I I would view that as an extremely impressive result and growth rate in a mature industry. Obviously, market movements do help. So there's a combination of inflows and market movements which boost that number. And you can see that net inflows were 1.6 billion pounds in a single quarter. So a very nice result from AJ Bell. Clearly, they've got a winning formula, and they've got a winning proposition. Um, and then we've also got a third-party asset under management section here, AJ Bell Investments, and this is an amazing growth rate of 49% over the last year. So, okay, it's not a huge fund management business. The other fund management companies that I study, they may have 20 or 30 or 50 billion pounds under management. So at 6 billion pounds, this is a small fund management business, but that's a remarkable growth rate of 49% in a year, 12% in a quarter. And so clearly there's something happening here. There's a successful growth story here. And who knows where that could ultimately lead, but it's a huge result there. In terms of the chief executive's comment, uh, obviously he's very happy. They've surpassed 500,000 customers. Um, they've got, obviously they've not been listed that long, but the progress since then, in terms of the growth of the business, has been excellent. And what were the other key points here? Well, AJ Bell Investments, it's important to point out that they enjoy success not just on AJ Bell's own proprietary platform, but also on third-party advisor platforms. So that's a sort of standalone business. Uh, who knows? Maybe it would be even spun off someday, but it's a successful standalone business. And then going back to what I said about the company offering good value to its customers, they've got a headline dealing fee of only £5 for the direct-to-consumer business. They also pay interest on cash balances, and this is a controversial topic. I think the FCA is taking an interest in this topic, so stockbrokers do need to reflect on it and make sure they're not at risk from a regulatory point of view. But AJ Bell is currently paying out between 2.5 and 3.5% interest on ISAs and a range of other interest rates as well on other account types. So strikes me that it's a reasonably generous rate that they're paying, and I would imagine that they would not be at any risk from a regulatory point of view in that. In terms of the valuation of this company, if you check it out over on Stockopedia, you'll see that it's trading at a PE ratio of about 16 times earnings. For a high quality business that has parts of it that are growing very quickly, I would probably take a positive view on this. Of course, do your own research, but personally, I like the outlook here. Maybe that's not a huge surprise because I'm obviously a Hargreaves Lansdown shareholder, as I've already said, and so I am bullish on the sector. So it would be strange if I thought that Hargreaves Lansdown had a very bright future, and if I also thought that AJ Bell was doomed for some reason. So I like both companies. I think they're both excellent, and I like them both as potential investments. Interesting here about AJ Bell, they're launching a ready-made pension service which will help customers to easily consolidate their existing pensions with AJ Bell and invest them automatically via their low-cost in-house investment solutions. I'm sure there's a lot of small startup fintech type companies who will not be happy with that announcement, because that is the type of service that a lot of small companies have been trying to do. So it'll be interesting now. We've got AJ Bell getting in on it and doing it themselves. And obviously they need to drive increased awareness, because I don't think they have anything like the brand recognition of Hargreaves Lansdown. So they do need to keep working on that. So this is an excellent update by AJ Bell. Nothing really that would concern me. I don't think it's a slam dunk investment opportunity. You do have to pay 16 times earnings for it, so it's not cheap, but it is a high quality business in my opinion. So always worth keeping an eye on. And the shares haven't made much progress since it was listed. The business has grown, but the share price hasn't really made all that much progress over the years. So could be the type of thing that's grown into its valuation and is now actually a decent opportunity. So I'll move on from AJ Bell now. Adrian is in the comments on the topic of Volex, referring to the point that the company had a significant revenue input from an acquisition. He says, I like the company, but I'm not sure one can be unequivocal until the full year results are published. I used to own, and it is on my watch list. Yes, so I did cover Volex. I'm not sure if you were with us at the start of the show, but I did make the point that organic growth at Volex is probably quite low. So that is important to keep in mind. Okay, so that's AJ Bell covered. Let's move on to something else. We might take a break from those types of companies and just go over to the homepage. So see what's on the Vox Markets homepage today, and we've got plenty of articles for you to check out, published this morning. And in terms of the most read RNS, clearly there is a huge amount of interest in Argo blockchain because a notice of its full year results is the most read RNS. We've got a few other things. We've already covered Volex. In Audio Boom, there's been a token purchase of shares by a director. A few other bits and pieces here. The second most read RNS is this one, very small business, Challenger Energy Group, £15 million market cap, and it is the most read RNS today on Vox Markets, with news of a strategic investment. Again, a small deal, £1.5 million, but the share price has gone up by a few percent today. People clearly like the news. I would note that the loan involved here, £1.5 million, is charging 1% interest per month, which is not peanuts, but given the high risk sector that we're talking about here, probably quite fair, and it will convert to equity if projects are successful and complete as they are supposed to. So that's the most read RNS today, Challenger Energy, which is described as an Atlantic margin-focused energy company. So there you go. It's exploring in Uruguay and it's producing in Trinidad. Challenger Energy. Okay, let's move on to something else. Plenty of updates we could look at today. Let's take a quick look at Deliveroo, a big company, but an interesting one. £2.1 billion market cap. Shares are up 7% today. It's interesting that it has been consistently loss-making over the years, and it's not. I mean, if you look at it without any bias, you might assume that it's highly profitable, but then you find, well, actually, it hasn't been. But anyway, we've got a Q1 update here, which is fairly positive. We've got a return to growth in orders. Gross transaction value up 6% year on year in constant currency, and orders up 2% year on year. So it's not huge growth, but it is some growth. And then in terms of their guidance for financial year 2024, which I guess is the calendar year 2024, they say adjusted EBITDA expected in the range of 110 to 130 million pounds. I have checked previous results, and I saw that the adjusted EBITDA had a huge gap between adjusted EBITDA and the net profit result. So it'll be interesting to see now, will they be able to reduce the level of adjustments and items? I wouldn't bet on it personally. They do say that they are free cash flow expected to be positive for 2024, and gross transaction value growth should be in the range of 5 to 9%. So it's one of these tricky ones where you've got a brand name with enormous recognition. You've got a very big company with billions of pounds of gross transaction value, tens of millions of pounds of orders, £500 million of revenue, and no profits. So what will happen to make that change? I don't know. I think it's the sort of business where you could make an argument that it will turn into a high quality portal type business with sort of a huge market share and monopolistic power, but I'm not totally won over yet. I'm open-minded. I would like to have the case made and to hear the case, but I think there are better businesses out there. So Deliveroo not on my watch list, but at least they have some positivity to report for shareholders today. Let's move on to something else. Here's LINV, LINV. This one has been has seen an enormous share price collapse since its 2021 IPO. But of course, what happened in the past isn't too relevant if the future is bright. So let's look at today's trading update. So this is the UK's leading platform for mortgages, in its own words. And essentially, they spent the first half of the year, of the financial year, trying to get things under control. So you can see that they had to have a restructuring. They prioritized liquidity, balance sheet flexibility, and reducing their cost base. And now in the second half of the year, they are experiencing a turnaround. So maybe we will have a brighter future here for shareholders than we've had so far. So you can see that they've got a third party business, and they also manage their own assets as well. And what they've been really trying to do is reduce the size of their own balance sheet and increase the third party assets that they're managing. I looked at their most recent balance sheet, and it had total assets of £954 million, and it had equity of only £67.5 million. So it had an extreme amount of leverage. But what they had managed to do was reduce the percentage of the assets that they were managing that was their own balance sheet assets from 50% to 31%. So basically a huge retrenchment. They're trying to get assets off their own balance sheet and, I guess, deleverage. So anyway, this trading update from LendInvest to me shows that they've had some success in the new strategy, and it is possible that the new year will the next year could be bright. So in the outlook section, they say that they are cautiously optimistic of profitability, returning to profitability in FY March 2025. They see rising confidence in the UK property market, largely due to expectations for falling inflation, declining interest rates, and falling swap rates. So, if I remember correctly, because I've studied this company a couple of times before, it was really all about interest rates. This company floated in 2021. Obviously, companies in general tend to time their IPOs quite well. And the 2021 interest rate assumptions were not the same as the 2023 interest rate assumptions. So for a property lender, it was just night and day. It was a completely different situation they ended up in a few years later. But perhaps we've got some stabilization here. Here's some interesting points. Mortgage approvals for house purchase for the period ending February 24 were up 39.8% year on year and up 32.5% for remortgaging. So there are significant signs of a rebound there, and they've got. I mean, this is interesting. The profit before tax for FY March 24 is minus 16 million pounds, but that could turn back to break even in FY March 2025 based on the company's cautious optimism. So I still think that this company is highly leveraged, highly risky, but who knows? It could turn out to be a bargain at current levels, especially if we got interest rates falling faster than people expected. Honestly, this is not one that's on my watch list for purchase, but I am curious to see how it plays out. Mello is in the live chat and says, asks me if I'm interested in Alpha Financial Markets. I don't think you're the first person who's asked me about this one. I will take a note of Alpha Financial Markets AFM. So thank you for that. Okay, let's move on to something else. So we've got Devolver Digital, market cap 105 million pounds, ticker DEVO, and we've got preliminary results for the company. This is another indie video game company, so basically you could speak of it in the same breath as Team 17, which we discussed recently. So we've got FY23 revenues in line with expectations. The share price here is up 10% today, so the market clearly likes these results. So key points here would be that the company has released new titles, or it's releasing new titles in 2024. It's had to restructure a little bit during FY 2023, but overall the performance is meeting expectations, and they've got net cash of $42.7 million, which does cover a decent chunk of the market cap. Remember, the market cap was only 105 million pounds. So net cash of $42.7 million. That is a significant achievement, a significant chunk of that. It's sort of another case of a tale of two halves, where the revenues in H2 were much better than the revenues in H1 last year. And in the outlook for 2024, as I said, they've got new titles coming out, 10 new titles to be precise. They say that they've got a healthy pipeline of 30 new titles out to 2026. The back catalog also has momentum. As we said the other day, these indie games, in my opinion, they do rely on their back catalog a lot more than the video game companies which release sort of blockbuster flagship titles. Yeah, overall, this seems like a fine update. Hard to criticize much here at all. And the CEO comment speaks very happily about a recent acquisition that they made. Back catalog sales expected to continue to benefit from this Cult of the Lamb game and this other game called Inscription, which have continued to perform strongly and help to offset the ongoing trend of lower revenues from subscription deals. I think one of the main difficulties with these indie games developers is, we've seen it at Devolver, that they are to some extent at the mercy of the consoles and the sort of big platforms. Think of the likes of Steam, STEAM, where people stream their games, and then you've got Microsoft with its subscription offerings for gamers and so on. And so these indie game owners, they sort of they have to accept deals with these larger companies, and I don't think they have a huge amount of negotiating power when that comes about. So that is a tricky one. That is the tricky bit. Um, let's scroll down and see the income statement here. Uh, so we've got gross profits for 2023 for Devolver Digital of $24.5 million, which is actually up from last year, despite much lower total revenues. So they managed to grind out a gross profit that was quite good, um, but they did produce an operating loss and a loss before tax. So definitely still got a lot of work to do to improve things. Um, personally, I am more interested in frontier developments because it creates uh, flagship games, and so they are basically cutting edge games. The indie games are not cutting edge games. They do have an audience, but I just think it's a bit more commoditized, and you are going to have to accept deals with the large sort of console and PC gaming platforms, and that is a hard task to do. George in the comments says he imagines things like the Xbox Game Pass doesn't help them. Well, like the games publishers, they want people like Microsoft with the Xbox to have their games included in the Game Pass, but then it's Microsoft which has all the pricing power, the negotiating power to determine what they're willing to pay for sort of the small uh, sort of low budget games. It's the publishers of the big budget games which I think have all the power to negotiate pricing, and that's why Microsoft wanted Activision Blizzard, because um, it's not about controlling Call of Duty and restricting Call of Duty to only the Xbox. It's about no longer having to negotiate with Activision anymore because they own Activision. Um, okay. Adrian's back in the comments, says, I did not think the EV improvement was positive, as all the news is about falling demand for EVs. I've taken it off my watch list. Well, yes, I did specifically comment on that. I noted that electric vehicles were weak last year, and that could be a source of weakness. If you think that EVs are going to remain, are going to see their popularity continue to fall, then that could be a source of weakness. Volex thought that things did improve more recently on that front, but it is a tricky sector to be in right now. Okay, that's Devolver. We're going to go over the 45-minute mark today because I do have something else I wanted to look at. So Discovery, DSCV. So Discovery, this is another company that's very broad, 5,000 employees in 20 companies, producing a wide range of electrical components used in industrial applications. It's quite a big company, 673 million pound market cap. And I just wanted to mention it today because it does have a pretty solid track record. So for people who like companies with that long track record of profitability, this does have that. And the trading update today was in line. And I had just a few points to make. The leverage, it was reasonable. So I don't have much concern on the balance sheet front right now. Of course, that could change, but you can see gearing at year end of 1.5x. The progress they reported, net revenue growth of 2% from acquisitions, with a 1% reduction in organic sales. So it's not the first company we've looked at today which has struggled to produce much revenue growth over the past year. So maybe we can sort of give companies a pass in 2023. That was a tough year, and hope for better going forwards. So a 1% reduction in organic sales, but they do insist that they are making good financial and strategic progress. And another company which thinks that the latter part of 2023 was strong, giving them confidence for 2024. So you can see they returned to organic growth in the latter part of the year, delivering fourth quarter organic sales of 2% year on year and 11% sequentially. So a big improvement in Q4, and that's 7% organic growth in the sensing and connectivity division, a 1% reduction in magnetics and controls. So it seems like a decent update with some positivity going as we move in further into 2024. Signs that while 2023 was very tough, things have improved for companies more recently. So giving some confidence, and the operating margin here improved as well in H2 along with revenues. So that's Discover IE. Seems like a pretty decent company, and quite a nice update from them. Okay, so as usual, I've got more companies to cover than I have time to cover them. Let's see if we've got time for a quick look at this one, if we can get this. Keystone Law. So what have we got here? Final results from Keystone Law. Market cap 198 million pounds. Shares down 5% today. And yeah, I find I don't think I'm ever likely to invest in a law firm, but these are pretty decent results, it seems, with revenue growth of 15% and a decent number there in adjusted PBT. So the outlook statement here is also quite good, but it's in line with expectations. So I just thought I'd mention that in passing. But I'm kind of, I think I'm going to run up out of time here, folks. So I'm going to have to call it a day there. But we did get through a decent amount, Volex, Deliveroo, and so on, and the takeover of Hipgnosis. So we've covered a decent number of shares. I'd like to thank you very much for the comments in the live chat. I enjoy the interaction. Please hit the thumbs up if you enjoyed the show, and I'll be back at the same time tomorrow afternoon. So best of luck, everyone. Appreciate the feedback, and talk to you soon. Bye for now.